Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's get to the bond market for a moment. It's been a really interesting couple days. So yesterday you had a lot of buying on the front end and you had some selling on the back end. Today, buying pretty much across the board. It's really that bull flattener that we're seeing. Joining us now is Ira Jersey. He's chief U.S. interest rate strategist over at Bloomberg Intelligence. First question goes back to yesterday. Was the long end selling a reaction to needing to liquidate to cover shorts in the yen?
Well, I don't know if it was only the yen. It was also that a lot of people wanted to get into the front end because of the idea that we'd see deeper interest rate cuts, and because of that, you have to, if you're a real money investor, you have to raise that money from somewhere because you might not have all of that in cash. So you have to sell something to fund your purchases in the front end. I think part of it too was you had a decent 5-year auction. So you had some people who were saying, again, buying the belly and the front end and selling the back end. And then secondly, and this was really interesting, is that there were some people who maybe were hoping, and dealers who were hoping to get rid of some inventory into a Treasury buyback that occurred yesterday. And the Treasury didn't buy anything. They were, people were expecting them maybe to buy about $1 billion worth of 7 to 10 year notes, and they didn't buy any because I guess that sector was rich. So when you didn't have that, dealers have more inventory than they thought, and basically had to back up their prices, and that means higher yields.
Ira, we had that really strong GDP print this morning. Tom Keene was making the point earlier this morning that how can the Fed cut into something like that? The economy doesn't need it right now. What do you think?
Yeah, well, it's a momentum issue, right? Because keep in mind that the second quarter GDP report was for April, May, and June. So April and May we know were reasonably strong, and clearly June wasn't terrible by any stretch of the imagination. Economic momentum is slowing, so at some point the Federal Reserve might cut interest rates. But I agree with the idea that and we've always been skeptical about a September cut being the first one. And again, I don't really care. I think big picture, if it's September's the first cut or November's the first cut, it doesn't really matter. At least unless you're trading instruments that happen to mature in those months. So yeah, I think it is difficult, and it just shows, and what this report shows is that the economy, while it's not where it was a year ago, it's still not weak, and that's the challenge that the Fed has, is how can they cut until the economy is actually weak, and you just don't see that very much. Even with 4.1% unemployment, that's not crazy high unemployment by any stretch of the imagination.
So based on that, what kind of curve do we expect? As in, is it going to be buying the front end, or is it going to be selling the long end?
Well, eventually it's going to be, I think, a bull steepener. So that means that front end yields are going to go down much faster than longer term yields. But that's going to come in fits and starts because of the same reason that we've seen it the last couple of quarters, quite frankly. And that's that we don't know when the Fed's going to start. And once the Fed starts, then the question is how fast do they go? And we've been of the opinion at BI Rates that the longer the Fed waits to cut, the deeper it's going to have to cut. And we do think that they're going to cut probably once this year, maybe twice. And once they do, they'll keep on going and keep cutting at least 150 or 200 basis points over the course of a year. And as that occurs, that's when you see the front end really start to gain some traction. But keep in mind, yesterday was interesting because the curve steepened 10 basis points. It only had steepened 18 basis points the whole year, right? So you're talking about a massive move in terms of just relative to how much we'd moved this year in terms of the 2 versus 10-year curve.
All right. Looking at that 2-year, we're at 440. We were at 5% just recently. Is that 60 basis point move? Is that a reasonable kind of move in that time frame, or is this a market that's been moving pretty quickly?
It's not that unusual. If you go back in time and you don't include the 2012 to 2018 period, it's usually the range of 10-year Treasury yields is somewhere around 100 basis points in a year. So seeing moves of 40 to 60 basis points over a 6-month period is not that unusual. In fact, we've had 3 of them just in the last 2 years. You go back to last October. We went from in August we were near 4%. In October we were near 5%, and then we've rallied all the way back down to under 4%. Right. So you're talking about a 100 basis point range that we're in, and now we're headed toward the lower end of that. I think ultimately we will see by the end of the year a more substantial and obvious slowdown in the economy. So that's where you can see 10-year yields actually fall below 4% once again. But it's not. But it's going to be choppy. It's not going to be one-way street. It's not one trade that's going to bring us there.
All right, Ira. The men's Olympic soccer team lost 3-0. See what I did there? 3-0 to France. What do you make of that game, and what are your expectations for the U.S. team?
Well, I have to. So keep in mind, on the men's side, this is the Olympic team is the under 23s, and and a lot of our best players are actually under 23 and not at the Olympics because they play in the first team and they played in Copa America earlier this year. So it just shows you that the depth of talent in the U.S. versus some of the other big countries like France. France has very deep talent pool and they have a lot of under 23s who are outstanding players, and for us, we have some players that are outstanding at under 23, but there's a talent gap there from the top to the bottom in the U.S. Clearly in that age group.
And again, why do they play before the Olympic opening games? There are just too many? Is that the thing? And if you play earlier, do you not get to go to the Olympic opening ceremony or no?
In the world of soccer, Ira, the Olympics aren't nearly as big.
No, they used to be until the World Cup came around in 100 or so years, just about 100 years ago. But one of the reasons that the Olympics soccer starts early is because you can really only have 2 games a week. And the Olympics itself is only 2 weeks. So unless you had 8 teams only going to the Olympics, it'd be hard to finish the tournament before that. So that's why you have. If you have 16 teams like they do, I think it's 16 if memory serves, you basically have to start a week before or a couple of days before the actual opening ceremony.
Adding more and more value every day. Ira Jersey with the Soccer Talk. He's also has a side gig, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's stay on earnings and things for a moment. Southwest Airlines up by over 3%. They are changing their open seat policy.
This is huge.
This is huge.
Yeah, I never really flew Southwest that much, and I don't know the reason behind the open seating, but I know that people like it. Cheaper.
Yeah, and also then you can pay for where you stand online and stuff, right?
Yeah.
Wait,
all right, let's go to
the fact that you can get on an airplane, then you have to scramble to find a seat?
No, I don't.
I don't either.
But
like
I mean,
a lot of people do like
if I'm super budgeting, then maybe that would be something. But they are keeping their bags fly for free policy. But George Ferguson is Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst, joining us now. What did you make of them scrapping this open seating policy?
Yeah, it's all about revenue generation, right? So I think they're trying to put a little more distance on themselves and the low cost and ultra low cost carriers, Frontier and Spirit. I agree with you. I don't know that all of us enjoy sort of scrambling for a seat when we jump on an airplane. So customers maybe take this better than them scrapping bags fly free or no change fees. So to me, it seems like could be a good evolution in the strategy, makes them look more like their full service competitor, brethren, United, American, and Delta. And again, they need to generate some more revenue, so they're going to sell you aisle seats, window seats, exit row seats, premium seats. Yeah, they're starting to look like they're big airlines. They're starting to look more like the other big airlines.
And Alex, I note from the YouTube video that George is in our Queen Victoria Street offices, which are just spectacular, because he was at the Farnborough Air Show boondoggle in London this week. So good for George. Hey, George,
Don't tell anybody.
Every plane I get on, don't worry, I won't tell them because they're not in the office, your management team. The reason I go onto a plane, every seat is full. So that implies to me that demand is there. That implies to me that the airlines would have pricing power. But I keep reading that they're not getting good yields and that the fact that the fares are coming down. Can you explain how this economics works?
Yeah, well, so I think this economics is the airlines put too much capacity in the marketplace. And this business is one where you don't let an airplane roll down the runway without it being 85% or more full nowadays. The revenue generation officers, they just keep selling tickets as long as it's covering the marginal cost, right? And so just because you saw all that volume didn't mean you were seeing all that, revenue as good as it should have been. Now, look, they're all at record levels of revenue, and that's because they got to find a way to pay for higher pilot wages. They're not anywhere near record levels of profit. So again, I think they were kind of counting on an even stronger revenue environment. As they might say, we saw yields at American down 6%. That's pretty. So I mean, yields look like they're nosing over, and that's a lot about the concern here, right? We're seeing negative yields at all the airlines, and that's the concern that there's just too much supply. Consumers kind of is tighter and not willing to pay anything to go on vacation. And that's the challenge here.
You got to hop in like 30 seconds. But American Airlines stock is now up over 2%. So what led that to the upside now?
Yeah, so some of the guidance I'm seeing is increases of 2-3% of capacity in 3Q. This could be the beginning of getting the capacity growth in the right area. I don't think it's going to be a great quarter, 3Q, but it could be better than we all expect.
All right. Thanks so much, George. Appreciate you. George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst, joining us on Southwest as well as American.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So let's get back to earnings here. Astrazeneca, that stock over in London, is now down by almost 2%. The company did report earnings that were pretty solid. The company came in with core earnings per share at 1.98 cents, $1.98, let's say it that way. Operating profit coming in about $4.10 billion. So we want to check in with the Chief Financial Officer, Aradhana Sarin, over at Astrazeneca on this. It's great to get your perspective. We always appreciate the busy day that you have on earnings. Thank you very much for joining us. Give us some clarity on that top line growth and the upgrade that you had. You're raising that revenue. What is driving it in terms of product sales, and how much of that's collaboration income?
So actually, all the upgrade is being driven by product revenue. This year, we had this quarter was actually a record quarter, $12.9 billion in revenue, and it was driven across the board with record revenues in all our therapeutic areas. So oncology, which is about 41% of our business, $5.3 billion in revenue, growing 19%. Cardiovascular medicines are growing 22%. Respiratory and immunology growing 26%, and our rare disease business, which is about a $2.1 billion business, growing 14%. And same geographically, we're seeing very strong growth in the U.S., double-digit growth, also in emerging markets and in China, both growing around 18%, Europe 24%. So it's really demand for all our innovative medicines across different geographies and across different therapeutic areas. So we raised our guidance for the year, both on revenue and EPS, to now mid-teens. And it's almost, in some ways, you could consider a double raise, because we also said that we would meet these guidance without any increase in collaboration revenue that we were anticipating earlier in the year. So it's really driven by fundamental underlying growth.
So, Doctor, I know I'm just looking at the Bloomberg terminal here. I see you have a run rate revenue of about $50 billion right now, and you guys have said that you're targeting $80 billion in sales in 2030. What's going to bridge the gap? What's going to get you there? What should we be keeping an eye on?
So, there's a lot going on in the pipeline. What's the ambition that we set for 2030 of 80 billion is driven by, I would say, three different elements. The first element is the products that we have today and the indications we have today and growth in those, and that's sort of what you see in the quarterly performance today. The second element is the current products that are on the market, but what we call life cycle extension. So entering into, for example, additional indications or expanding indications in other tumor types, et cetera. That's the second element. And then the third element is new molecular entities. So these are brand new molecules which we've discovered, we're working on, that are in phase 2 or phase 3 clinical studies, and hope that we'll be successful in them and we'll launch them by 2030. We have set an ambition of achieving this revenue, but also launching 20 new molecular entities by 2030, having 25 blockbusters, so that's products over $1 billion in revenues in the year by 2030. And what's going to bridge the gap? If you look at the studies we have ongoing, we will have probably about 40 studies in the next 18 months. So by end of 2025 that we hope to read out, and that will give us more confidence with the trajectory that we're on achieving that 2030 ambition. So, this is it's a risk business. Obviously, we take risk every day. We invest 22% of our R&D, of our revenue in R&D. So it's a very R&D heavy business. And, we hope that, our studies are successful to achieve those goals.
Are governments your friend or foe right now in terms of the UK being an unfavorable or favorable environment? There's also the threats of IRA potentially being rolled back under President Trump. How do you guys sort of think about government interaction with your company?
Governments are a very important stakeholder for us, in the U.S. As well as outside the U.S. Many systems, healthcare systems are single-payer systems, so we do work very closely with governments. The most important thing for us is to make sure that we have, once we've spent the money and developed innovative medicines, whether it's for cardiovascular disease or oncology, that patients actually get access to those medicines, and we can make an impact in their lives and, from diseases they're suffering from. And in that way, we need to be able to demonstrate that these drugs have value and are bringing value to the patients and to the healthcare system. And we work very closely with governments and with systems to make sure we get access to those medicines.
Dr. Sarin, I always joke on the show that when I come back in the next life, I want to be a healthcare M&A banker, because it seems every Monday we come in and there's another deal out there. How do you and your company think about M&A to kind of drive top line growth versus the R&D that you've already talked about?
So the ambition that we set for 2030, the 80 billion, does not include any major M&A. We are always looking from a scientific standpoint, not only within our own labs and identifying, what could be the next most promising molecule, but also looking outside and science that is happening in universities and biotech companies and so forth. Over the last year and a half, we've invested close to $7 billion in doing licensing transactions and partnerships and smaller M&A transactions that help to build our pipeline and really fit very well strategically with us in terms of the ambition that we have, and particularly in new therapy areas where we've made some investment, but it can help us leapfrog into the field, for example, in the case of cell therapies or in the case of radiopharmaceuticals, and accelerate the investments that we're already making. So, we're always looking for those types of partnerships.
So this is a really un-CFO-y question to ask you. What's the coolest drug that you guys are working on right now? The one thing that you're most excited about and a potential breakthrough there?
I don't know if it's an uncool or maybe it's unfair. It's hard to pick from your children, right? So there are just so many exciting things happening, and every few weeks we get some new data that makes us excited. So it's really hard to pick a favorite child. But there's a lot going on, and we live in very exciting times where not only is what we do in AstraZeneca is important, but science is evolving so quickly, and technology is evolving quickly, and we're sort of at the forefront of that innovation.
All right, thank you so much. We truly appreciate it. Aradhana Sarin, Chief Financial Officer over at AstraZeneca, joining us on earnings. Really appreciate that. Now, I'm an only child, and I only have one daughter.
Okay.
But I'm always assuming that as a parent, you have a favorite.
Well,
or does that not work like that?
Well,
you have multiple kids.
My 4 kids, our youngest has always told us that he is the favorite, and this is when he was a little boy, because he gives the best presents and the best hugs. So I'll stick with. He's now 20 years old, but I'm going to stick with that.
Okay. So maybe
I still get grief from the two saying, "Well, you have more pictures of him than me on the table."
So you may not actually pick a favorite, but they think you do.
Yeah. I like the way you put that.
So drugs aren't sentient beings.
See,
so
I cut them all off.
Do that.
Once they graduate college, they're done. So they're on their own. So that's equal opportunity.
Equal opportunity, tough love from Paul Sweeney.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, "Alexa, play Bloomberg 1130.
All right, Alix Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well, so head over there and check us out on the video side. One of the topics that Alix and I love to focus on, we think it's really important, is commercial real estate, the opportunities, the risks out there, and the risks are big time. We talk about that a lot. Today we're going to focus on, I think, the hotel business, the hospitality business, the resort business. Great guest in our studio today, Sean Hehir. He's a principal and managing partner at Trinity Investments. The office is in Honolulu, Los Angeles, London. I don't see Cleveland here. He's based in Miami, a good place to be with everybody else in financial services. Sean, thanks so much for coming into our studio here. Let's start with the pandemic, because your industry literally shut its doors, locked, and threw away the key here. Tell us about what happened in your business and maybe opportunities coming out.
Sure, thank you, and thank you so much for having me today. So I'd say the start of the pandemic was truly devastating. We typically own brand-managed hotels that are 400 rooms and larger, and typically in the smile states of Florida, Texas, Arizona, California, Hawaii, Cabo. Nice. And we had to close all of these properties. And I've likened it to stopping a supertanker midstream trying to close these hotels. But we used that time to really complete renovation work, to accelerate repositioning of the assets. We also used that time to raise our first commingled fund, which was a GP fund, and became one of the largest, most active buyers of hotels in the US during that time. I will say that all of these properties that were closed during the pandemic have come roaring back. They're now renovated. They're seeing incredible demand, having record month-over-month performance. So we've come out of it well, but it was scary at the start of the pandemic.
Do you foresee that kind of demand continuing? We've just been trying to figure out what that leisure travel budget winds up looking like for those that have budgets and for those that don't.
I just read a statistic today, Alix, that said that in June, luxury demand was up for hotels 9%. And I think there's a 2% decrease in demand for the economy segment. What we're seeing with the work from home phenomenon in the US is that every weekend is now a 3 or 4 day weekend. So people are traveling more. At the same time, with the companies having to shrink their office space, they can't hold offsites in their offices anymore. So they're holding more offsite meetings to bring their teams together in the types of hotels that we own. So we're seeing compression between the leisure traveler and these offsite group corporate type travelers. So it's baited well for our properties.
So if you wanted to go out and buy a property, or if you wanted to refinance a property today, will the bankers pick up your phone calls? I mean, are the banks lending here?
We've been fortunate. I'd say our business more and more relies on relationships. And fortunately for us, we have tremendous relationships in the lending market and in the private equity. A lot of our partners are large private equity funds. We've completed well over $2 billion of financings and refinancings over the last 11, 12 months. So we see it robust. There has been more of a shift towards CMBS or SASB loans, but we've had loans as large as 150 million all the way up to 750 million that we've been able to execute in the last 12 months.
And are you getting that from banks, or is it private credit? Like, where do you go for that?
So it's a mixture of SASB and then non-bank banks.
What is SASB? I'm sure I should know this, but
it's the CMBS market, so single asset, single borrower, CMBS market. And so, yeah, that market is very active right now. We just refinanced our Diplomat Resort in Hollywood, Florida. It was a $575 million transaction about 2 months ago. We bought a resort for that Accor, which is a non-bank bank. They financed us in Scottsdale, Arizona. But it's all down to relationships.
You recently expanded into Europe. Tell us about that.
We're very excited about Europe. So Ryan Don, one of our partners, moved to London about a year ago, really at the request of some of our joint venture partners who wanted an operating partner like Trinity in Europe. We completed our first acquisition about 2 months ago. We bought the Park Hyatt Hotel in Zurich in partnership with Oaktree and UBS. And Ryan now has the core team of head of development acquisitions, asset management, etc. So we're very excited about the prospects in Europe.
Who are your competitors? Is that a really silly question?
We compete with all of the private equity funds, but they tend to be our joint venture partners as well. So we've done a lot of business with Oaktree, we've done a lot of business with Partners Group, with UBS, with Elliott Management, and so we partner with these groups. They rely on us for our in-house expertise. We have 45 professionals who live, breathe, and sleep hospitality. That's what they do. We're hospitality real estate experts. And fortunately, our competitors also collaborate with us.
What's a typical property that screens well for you guys in terms of an acquisition? What do you guys really look for, whether it's size or location or capital structure? How do you screen that?
In the US, we typically focus on brand managed, so mainly Hilton, Marriott, or Hyatt. And we typically focus on properties that are 400 rooms and larger, that are more destination type properties. And these tend to be in Florida, Texas, Arizona, California, and Hawaii.
So you would own the property, but Hilton would manage it?
Correct.
Okay.
And we're so fortunate with the relationships we have with the brands who really trust us with the assets. And we also buy from the brands. So we've bought 3 assets from Hyatt as they've gone on an asset light strategy. So Zurich was one, Greenwich, Connecticut was another one, and then Indian Wells in California was a third one. But
so
again, I'm not hearing Cleveland here. I'm not hearing Des Moines.
Do you want to go to Des Moines?
I mean,
stop. Of course we do.
We do. I mean, like, sure, but I mean, from what you're saying, these are sort of
these places.
I'm not dissing the places. I'm dissing the location for hotels. In that, if I'm going to go to a destination and I'm going to send a work trip or something, I'm not going to go to Des Moines. I'm going to go to a place where I can soak up sun and be in a pool and that kind of stuff.
Well, what we've learned is that you need multiple levers because things do happen like COVID that are unforeseen. Yep. So when you have one of these destination type properties, you have multiple levers between group, corporate, leisure, meeting space, etc., that you can play with to induce demand to the assets.
So are you guys net buyers today? Are you net sellers?
Where are you in?
All of the above.
Okay.
We're definitely net buyers. I think we're going to see the debt market stabilize. While we've been successful in them, you do need a more robust debt market to induce buyers. I think the minute we see, hopefully, an interest rate cut, you'll see a lot of demand coming back into the market. So we do have assets that are approaching stabilization, and in the right conditions, we will sell.
Well, Alix and I often, when we talk about commercial real estate, we just think about here, the 3rd Avenue in Manhattan, and we're hearing from experts that when these things trade on the 3rd Avenue in Manhattan, they're B office kind of properties, 30, 40 cents on the dollar.
Yeah.
If you go out and make an acquisition today of a hotel, you're not getting a discount, are you? I mean, are these things trading at about where they were trading, or are they trading at a discount to pre-pandemic?
I would normally walk into a convention or a conference as the hotel guy, and you'd be sort of the afterthought in terms of an asset class for real estate. What we've proven coming out of COVID is that we've been able to stay ahead of inflation because you essentially reprice on a nightly basis. So you can reprice your rooms, your food and beverage. The other side is that we typically trade at wider cap rates. So if we're buying at a 7 cap and we're financing at an 8% all-in interest rate, there's slight negative leverage, and it's a value-add investment that we normally do, so we work our way into positive territory pretty quickly. If you're predicated on buying the other real estate asset classes at a 4% cap rate, which used to need a 3% interest rate to make it work, you're way underwater in terms of that spread between where the cap rates and the interest rates are now.
Interesting. Go ahead.
No, just fascinating stuff. There's so many different areas and little tranches and slices of the commercial real estate business.
Yeah, it is really interesting. Sean, thank you so much. We really appreciate it. Sean Hehir is principal managing partner at Trinity Investments, talking a lot about the state of commercial real estate when it comes to luxury hotels. I don't remember the last time I feel like I've traveled. It's been so long.
Where we were down
Tennessee,
in
right?
Nashville.
Yeah, we were.
Hell, you were at the Gaylord Opryland Resort.
I mean, I clocked like 14,000 steps one
I know.
day, just like being a person walking around that hotel.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
And here we go. One of my favorite stories of the last 48 hours is what's happening in luxury retail. Hermès is going to be reporting after the closing bell in Europe, so that's after 11:30 Eastern Hour Time. We had the likes of all the other guys. Who are the other guys now? Richemont not doing really well.
Yeah.
Gucci sales disappointed, and that wound up hurting Kering, their parent company.
Yep.
LVMH also struggling. I mean, it's grim out there. Deborah Aitken is Bloomberg Intelligence luxury goods analyst, and she joins us on this topic. Deborah, how much of the weakness is a China problem versus a broader problem?
Hi. Yes, some of the weakness is a China problem, but I would say it's around 10% of the problem at the moment, because we were already against a difficult base last year where we saw the market only open in January last year, doing well until it took a while for stores to build again in China. And then we saw a drop off May, June. It picked up a little bit more by September through December. It contracted again. And I would say that into Q2, we're actually probably flat in China year on year. But what we have is actually some of the Chinese cohort, some travel to Europe, but especially and particularly travel to Japan. And that is skewing numbers.
Right.
And there's more into that we can talk about.
So, I mean, I guess the question is, what are these luxury brands? I mean, they've had a good run. Is this just kind of getting back to maybe a more normalized spending pattern by typical luxury consumers, or is there something else going on here? Because I can get a Gucci Jackie 1961 medium shoulder bag for $3,900.
Would you want to?
What?
How about
Wait,
that?
What just happened here? Did you look up luxury retail on your
I'm looking at the
computer?
Gucci site here.
Oh my gosh,
the
I've brain
Gucci
dump.
Jackie 1961 medium shoulder bag. Tom Keene was looking at this morning. $3,900. So
There
what
we
happens
go.
here?
Right, so probably two stories here. So let's touch on Gucci afterwards, but let me just run through some numbers to put what's happening this quarter and this half year into context. So we started 2024 by saying this would very much be a tale of two halves. And so I want to remind about what that means, because in the first half of 2023, the luxury market grew 20%. 20% in Q1 and 19.5% in Q2. By Q3 and Q4, because of the skew year on year, it grew 10% average. So as we head into the second half, we'll be looking at it facing 10% rather than 20%, which it faced in the first half of this year. And so in Q1 this year, it came through with almost 7% growth. In Q2, we've only got 6 numbers so far, 6 of the big reporters, and they're at 1%. So that's what you're referring to when you say, Richemont's only up 1%, LVMH is up 1%, because they're up against 19% and 17% respectively 4 quarters ago. So that's the issue there. The second thing on China, so we know that China numbers are about flat, where double-digit year-on-year, but about flat, and that we're seeing actually the Chinese cohort, a lot of that spend elsewhere. And then if we think about Gucci, I'm going to put that aligned to a Burberry which is also very difficult, or a Ferragamo, which comes out next week, where it's about really rebuilding and elevating the brand. And for me, Burberry have got it most wrong, and Gucci could do something by Q3, Q4 with new product in the marketplace. But it's a difficult area when you're trying to persuade not your own retail stores, but a wholesale store, so a boutique, a department store, to take the risk of new untested design on board at a time when there's real uncertainty about new designers and whether they've made it or not.
It's such a good point.
Makes sense.
It does make sense. The one outlier, though, has been Hermes, has continued to deliver, albeit maybe at a slower pace. They're going to report earnings in just about 15 minutes, give or take. What do you think we're going to see there?
I think much of the same from Hermes. There will be some slight slowdown, I think, in things like accessories, for example, silks, for example, maybe a little bit in perfumes and cosmetics. It depends on where they are year on year, category by category with growth rates. But there's another one too, which we can use to add some confidence for Hermes. That would be Brunello Cucinelli, which was one of the first to report, and it came through with 12% growth after 28% last year.
It's just so expensive.
So it's very high end. So anything that's high end, the consumer at the very high end is not so worried by prices having gone up 8 to 10% over the last couple of years. They're not so worried by monthly income coming in. Those with high spending power, they're still looking for to treat themselves for that luxury feel, and that's what's holding out. We also saw though Richemont is only up, as was said, 1% in this quarter. If you look behind those numbers, Cartier was still very strong, and Van Cleef & Arpels very strong. It was more their accessories and fashion side of things that saw more of a dip, not so strong growth, because the middle ground is just contested. There's uncertainty there around elections, the macro view. It's all tying together, but second half structurally becomes a lot easier for these companies.
When I was back in my tie-wearing days, I was a Hermes tie person. That was my go-to.
Super solid
brand. Yeah, solid. That's a Wall Street standard back in the day.
And then, there's another thing that runs on this, because I'm going to, I think, be really focusing on what happens on operations. Some of these companies have 40% margin down to 25% average across the sector. I think where we're getting a lot more of Asian overall is around a third of the luxury market, and we're getting a lot more of that spend into Japan. And if you think about the translation of these big euro-based companies, the yen being so weak has kind of given you an equivalent 1-to-1 euro to yen in terms of pricing, whereas if you were buying in China, in Hong Kong, you were getting 1.2, so the conversion was 1.2. So that also hits the top line in terms of value growth.
Yeah, back in the day. Hey, real quick, how about like Saudi Arabia, United Arab Emirates, Dubai, that part of the world? It seems like there's lots of cash there. Is that a big market for luxury?
If we bring it all together, it's probably moving towards 6 to 7%. So you would say it's one of the bigger, or just above the biggest European contingent. But it's certainly growing. Huge amount of investment moving into there, more so money coming in from Russia, from different parts of Eastern Europe, from parts of Middle East, into where they can't spend in particular areas. So there's a lot of infrastructure taking place, and a lot of new joint ventures and others being written in those areas too, which I see as being strong over the next 3 to 5 years. Similarly, we'll be looking 5 years on India as well as an upcoming market.
All right, Deb, thanks so much for joining us. Deb Aitken, Bloomberg Intelligence, covers all the luxury brands for us. I'm looking on the Hermes site. Pre-pandemic, when I was wearing ties, $200 for a Hermes tie. Now they're $260. So that's 5 years
that's not too
inflation.
bad.
No, and I think, and they last, a fair amount of time. And they're good, and but that's, but I'm just looking at the inflation, because again, I was at 200. John's laughing.
I mean, I'm looking at Bruno Cucinelli, where you're going to pay $2,000 for a man cardigan. I mean,
really?
That just blows my tiny brain. I just don't get it.
Yeah, luxury. I'm not.
What's it made out
Republic.
of?
What?
This is like some special.
I don't know. Magic?
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube, and always on the Bloomberg Terminal.